Hello, my name is Koku Dalisusi. I'm a researcher in finance and also I'm a consultant. Today we are going to continue our presentation about investment management process. So we have presented in our previous video the first three steps, and today we are going to present the fourth and the fifth step of investment management process. So after selecting a strategy of investment, an investor need to select a specific asset or specific asset to be included in the portfolio. That is very, very crucial for an investor. In this fourth phase that an investor attempts to construct an efficient portfolio. How do we call an efficient portfolio? An efficient portfolio is the one that provides the greatest return with a given level of a risk, or in another word is the one which provides the lowest level of risk with a given level of return. That is we call an efficient portfolio. How the investor has to proceed in order to construct this efficient portfolio. Before to arrive it, he needs to quantify a risk and to provide some inputs. Concerning the inputs, we can mention three key of inputs. Those inputs are future expected return or expected return. We have also the second key is the variation of asset return, and the third one is the correlation or covariance of asset return. So before to construct a portfolio, an investor need to use some econometric methods or models before to arrive it. So the construction of an efficient portfolio is based on the expected return, which depends on the expected return of all asset return, and also it is based on the risk measure of the assets, which depends on the risk related to the portfolio or to the return of the portfolio, or return of portfolio, or in other words, which depends on covariance between all two pair of asset return. That is very, very important. So if you want to resume what we have just said, is that the construction of an efficient portfolio depends on expected return, depend on the risk the risk linked to the assets of this portfolio. That is very, very important. That I want to say. We know also the risk, an asset is linked with some systematic factor and some components relate to the company or to the industry, to the industry. That is very important. So also we can quantify that there are two kind of risk. We have systematic risks, are the risks that depend on the company management, and on systematic risks which are related to the markets, macroeconomic, who are linked to the macroeconomic and the other factor. For the fifth step, the investor need to measure and evaluate the portfolio performance. So to do this, an investor need to use some tool based on some benchmarks. That's what we can say. There are three tools or benchmark that investors have to use. For example, when we talk about a ratio of Sharpe ratio. Sharpe is an American econometrician, economist, which has developed this tool to measure the performance of or to evaluate the performance of a portfolio. This ratio, when this ratio is bigger than or greater than one unit, it means that the portfolio's performance is very acceptable. It's very higher than the risk. Also, the second tool we can talk about the trainer ratio. Trainer ratio also is used to measure the portfolio performance, to evaluate the portfolio performance. Also, when this ratio is greater is this ratio, acceptable is this performance. So the third tool is Jensen. Is the Jensen ratio. Jensen ratio used to measure used to evaluate the portfolio performance related to the theoric performance of the portfolio. So when this ratio is greater than 0, it means that the investor have to accept this performance. So is what we can say about the fourth step and the fifth step of investment management. That is what we can say about it. Thank you very much.